Good evening, everyone. Time for another silver update. This is the 10-minute chart of silver on netdania.com. You can click on the link below. And you can see I've drawn a flat line across here to indicate the short-term resistance level that was in silver at roughly 35.75. You can see it's met twice here. Once, well, there's one here, but there's the main one there, and then this one here, and then the breakout. So you can see we broke out through this 35.75 level, and of course I had indicated previously that the 36 level was a key level, and we wanted to see what we did after that. You can see we ran, and then we began to run very strongly into a kind of new trend channel high, and then we got that massive smackdown that coincided with the Bernanke speech. So, and I've documented some things on this volume. Now, you always have to be careful about the volume because NetDania is reporting multiple sources, but generally, unless you've had a rollover into a new contract, a new close by delivery month, then you're normally going to be able to tell whether the volume has become abnormal. If we draw the line across from the anomalous trading that we saw with the candlesticks back on the 24th, you can see that we exceeded that significantly on the smackdown of the 29th, and today we exceeded it just a little bit, but not really significantly. So we seem to have come back to this level here. We can actually even draw in a type of channel based on a couple of these lows. So we probably want to draw it roughly right about here and just get the flatline channel there. So you can see we're right in the very middle of this channel, the one we established and we broke out of. And the question is, will we rise from here, or will we turn around, roll over, and fall? The MACD seems to be rolling positive at this point. That's not something you can rely on because obviously an intervention would change that scenario. So I wanted to examine further this smackdown that we had here, and I wanted to examine it in light of the bullion banks. So one of the explanations that you get when you have one of these large volume sell-offs and people are searching about for explanations, you have the question of who is involved here. So I wanted to delve into that a little bit. And the first site I'm going to start out with is the Silver Institute's page, which documents silver production. We've covered this page before, and it's a country-by-country breakdown. So obviously the numbers are going to be much smaller than you see on this page as far as individual hedgers, if you're talking about producing hedgers that are hedging their book. But if we look at the country-by-country breakdown, we can see that Mexico is the biggest producer, and then it's followed by Peru, then China, then Australia, Chile, Bolivia, and the United States. So these are the big guys here, and the question is going to be, when we get back to this silver chart, the question we want to ask is, who exactly was it who initiated this activity based upon the Bernanke speech? So we have a number of potential actors here. We have the producers or hedgers, and the first thing we want to look at when we look at the volume here is you can see we have multiple hits of the 30,000 contract range. Now if you multiply that times the 5,000, you're talking about 150 million ounces or so hit multiple times. So if we go back to the hedgers, this is yearly production. This is for 2010. So if these countries, if an entire country were hedging its production, the biggest one is going to be Mexico with 128 million ounces. And you can see with the volume that we did here that it's unlikely, it's possible, but it's highly unlikely that a country would come in instantly and try to hedge their entire production on the bet or speculation that prices are going to go down. So we can pretty easily dismiss the producers slash legitimate hedgers from being the actors that caused this activity. So the next one that's going to come up is the commercials that people talk about and the speculators. So it's quite possible that some speculators saw the statement by the FOMC and Bernanke in his speech, and they determined that that would be a very bearish scenario for the precious metals, and they would jump in real quick and short them. So if that's the case, if the speculators were basing their bets on some type of deflationary scenario, we would expect to see that in the other commodities. Now, of course, with gold, we saw it, and it definitely coincides, but we would also probably want to expect to see that with oil, and you can see that oil really doesn't fit that scenario as far as the sell-off that we saw. It recovered very rapidly, and on the latest scare has recently jumped into new highs and then backed off. But it looks like oil really wants to find that 115 level. If we go back and look at that 115 level, you can see that's hanging over the market here, and that is definitely a target for whatever traders, whether they be producers or hedgers or speculators, to gun for. So it looks like we're still going to make that run. But back to the main issue is, who are the speculators who came in and initiated the sell-off, and what was their motive? Now, the main actors I want to look at tonight are the bullion banks. So I picked a number of articles here about the bullion banks, and we want to start off with a real simple explanation of the bullion banks, and this is one from Blanchard, so we'll start with that one. And this is: bullion banks smarter than the rest of us, or just more informed? Bullion banks are the conduits for central bank gold being loaned into the market. And this is a theme we're going to see again and again as we look into this issue. Basically, the bullion banks are operating a loan operation based upon the gold that already exists and is being held. So, as Dr. Fichetti has pointed out, that gold, and others have pointed out, that gold is not a dead asset. It's not a buggy whip or some useless thing. It actually can be used as a backing for loans, and therefore it's an asset that can gain an interest rate. It can gain a return. It's not just a dead asset that can only be sold for capital gains. It actually has a function in the borrowing and lending market. So the bullion banks are the banks that loan out central bank gold, and of course there's a separate interest rate for that. Continuing, as the gold market has shrunk in the last decade in terms of daily volumes and market participant numbers, as a link to the LBMA, the reduction in the number of bullion banks involved in the market means central bank loans are handled by an increasingly smaller number of banks. There are currently only 6 banks clearing on the LBMA handling gold loan transactions. The 6 clearing banks are Barclays PLC, Scotia Macata, Deutsche Bank AG, HSBC, JP Morgan, and UBS AG. Hypothesize the following bullion market situation. Bullion Bank A wants to borrow 100 tons of gold to sell into the market. Bullion Bank A then contacts central banks X, Y, and Z to borrow the gold and begins negotiating term lengths and lending rates. Bullion Bank A selects Central Bank X's terms, securing 100 tons of gold through the loan and subsequently sells it into the market. By completing just one transaction with one central bank, Bullion Bank A now knows that 100 tons of gold listed in Central Bank X's IMF gold reserves is actually out on loan, and being the conduit for that gold reaching the market, they know the time and date that gold was sold into the market and the length of those loans. Bullion Bank A also knows what the amount of gold, lease rates, and length of loan central banks Y and Z are willing to accommodate, even if they do not complete the transaction with those banks. Now, extrapolate that one transaction over hundreds of transactions annually between Bullion Bank A and dozens of central banks. Bullion Bank A knows gold loan amounts in the market from their own transactions when those loans were made, and also which central banks are willing to loan what amounts of gold and at what contract term lengths. But bullion banks do not publish their borrowing activity. And with that, I wanted to take you over to the Adrian Douglas article, which documents how this issue becomes more and more shady as we start to look into the actual trading activity of these bullion banks. And we'll read a little bit of this, but Adrian points out that none of this is on the books. A bullion bank trading, a closely guarded secret. I've written extensively in the past about how bullion banking members of the London Bullion Market Association trade unbelievable amounts of unallocated gold and silver on a daily basis. See, for example, LBMA OTC Market, Alchemist Turned Paper into Gold. I also managed to introduce spoken testimony on the subject at the CFTC March 25, 2010 hearing, the metals markets, and he gives the article. The latest LBMA clearing statistics, February 2011, reveal that the LBMA Bullion Bank members traded a total average net daily gold volume of 18.1 million ounces with a value of $24.8 billion. Some analysts have in the past estimated that the gross volume is likely to be 3 to 4 times the net volume, giving potentially over 70 million ounces of gross gold trading worth $100 billion. This would be equivalent to trading all the gold that is mined in the world each year and every day. Clearly, the majority of this trading is unbacked by physical gold. The bullion banks only make a ledger entry for the gold sold or bought, and as long as the client never asks for delivery, the bank never has to have the gold. I have, through my studies, indicated that probably 45 ounces of gold have been sold for each one that exists. The bullion banking business is very opaque, but it struck me that the members of the LBMA are collectively trading a net value of $6.2 trillion annually. This should be laid out and explained in the Bullion Bank's annual reports. And I'll link this article. He goes into the very suspicious lack of any financial accounting on the bullion banks for how they make their profits and the trading that they do in the gold trading and loaning business. But I want to take you to the last article here, and this one is from goldeagle.com. This is another article about bullion banking, and he says the question was posed, what are the bullion banks actually doing? Being that this is a complicated and varied subject, I thought to present a simplified view of what was going on. I do not attempt to quote the statistics and details, rather to present a view that makes one aspect of interest to gold bugs a little clearer. Central banks have gold bars sitting in the back room. They are assets on the books, but they produce no income. They are non-performing. So the central banks lease this gold to the bullion banks to collect a little interest. The BBs take this gold and sell it. Let's stop here and see what the current state of affairs is. The central bank owns the gold. They have just loaned it out for a fee. The third party that bought the gold from the bullion banks owns that gold as they had just paid cash for it. Now two parties own the gold. The third party is probably a fabricating jewelry or electronic or making teeth for Mike Tyson. At any rate, the gold no longer exists in deliverable form, so we have two owners and no deliverable gold. Definitely not a good state. The Bullion Bank takes the proceeds from the sale of the gold it did not own and invests it. All is well and good if, and I repeat if, the price of gold does not rise, and if there is some source of available gold for delivery which can be purchased to repay this loan in the future. Again, let's look at the state. The CB owns the gold, the BB owes the gold, and the gold is gone. To fully understand the state, one must be aware that the world is producing, and he goes into the production of gold and how the central bank leasing works. So let's get back to the silver market, because this is the one that we're really looking at here, and a lot of people have looked at this type of move here, and my question is, who was doing the selling? Now, sometimes or oftentimes the answer is going to be the bullion banks, and this is my question. If, according to these three articles, the bullion bank's job is to create a interest rate or some type of profitable return on this non-productive asset, gold. So my question is, what about silver? Now, we know that none of the central banks hold any silver. So if the bullion banks are borrowing silver and they're selling it on the open market and they're leasing it at a certain interest rate, my first question is going to be, who are they leasing it from? Who are the bullion banks borrowing their silver from? They're certainly not borrowing it from the central banks, because the central banks don't have any silver. So are they borrowing it from the miners? Well, we've already looked at the miners, and we can see that, we can see that the miners don't really have any silver to speak of. The biggest producer is Mexico, with 128 million ounces in an entire year. That's an entire country. We're going to be talking about individual companies, so it's going to be a smaller breakdown of that. So we're talking about a volume in silver. You can see we have a spike here of about 60,000 contracts, and you multiply, let's do the math real quick because I'm not the greatest at that. If you multiply 60,000 times the 5,000 in the contract, we're talking about 300 million ounces of silver. So who is the central bank in this situation? Who has 300 million ounces of silver who's loaning it to the bullion bank who's able to short it? So that's the question I want to throw out here. Who is it that's selling this silver? This is not at all the same as gold. There is a ton of gold out there. There's millions, not millions, but there's just an enormous amount of tons of gold out there held by all the central banks. As we pointed out, the central banks have been stockpiling gold for many decades. The world has been stockpiling gold for thousands of years. But silver, on the other hand, is being used up on a continual basis, and the above-ground supply may be lower than actually 1 billion ounces. So if it's the bullion banks who made the sell-off here, whose silver did they borrow? If it was the miners who did the sell-off here, what silver were they hedging? If it were the speculators who sold off the silver here, why did they decide to sell such a large amount on the speculation just of this economic news? Why did they decide, oh, we're going to go sell the heck out of silver, but we're not going to sell oil, we're not going to sell these other things? And who's left? So the question of the day is, who is doing this selling? And my contention is that the people that are selling this silver are not like the bullion banks selling gold. These are purely naked silver shorts. My contention is that it is people who are backed by the central bank, people are backed by Bernanke, people are backed by the government of the United States who are intentionally selling silver that doesn't even exist. And if that's the case, the situation in silver is much, much more dire than the situation in gold. Because ultimately, if they have to, central banks can pony up the gold, deliver it to the bullion banks, and the bullion banks can deliver it to the people who are asking for it. But with silver, there is no one to pony up that silver. It literally does not exist. And for that reason, I think silver is probably going to go at least tenfold higher when this move happens than gold does. And we'll talk to you next time.